The objective of the Deloitte CFO program is to bring you insightful and inspiring information, and therefore I have three colleagues with me today to guide you through the new directive. We have Sofian, who has a very strong experience in providing assurance on non-financial information. We have Bart, who is advising organizations on getting it done, and Tom, who masters sustainable financing and relating criteria. Today, we will talk about the EU directive itself. It was published very recently on April 21, and it is about comparable, reliable, and relevant non-financial information and the relating EU taxonomy. In order to avoid confusion, the EU from now on refers to non-financial information actually as sustainability information. But indeed, it refers to information on environment, social, and governance, so the full ESG scope. However, the current taxonomy, as published on April 21, mainly refers to the environmental part of ESG. The remainder will be published later on. Before I will give the word to my colleagues and you will enjoy the seminar, there's two practical items I would like to bring forward. First of all, you will see there is a Q&A section. So in case you have questions or remarks, do not hesitate to post your question out there. We will come back to you after the seminar and try to give a response to your question. And in addition, you will have noted that we are recording this session. So we will make it available afterwards, both on the website, and we will forward you a link. So if you want to review it or send it through to your colleagues, do not hesitate to do so. And with this, I will give the word to my colleague Sofian, who will enlighten you on the ESG directive.
Yes, thank you, Tom, and thank you for the introduction. Also from my side, a very warm welcome to this webinar. And I would like to start by saying finally, because indeed, finally, the European Commission has issued the new proposed directive with regard to the reporting of non-financial information 2 weeks ago. We in fact expected this directive at the end of last year, but due to the COVID situation, it has been delayed with a couple of months. The directive is a very important directive. It will have an impact on a lot of companies. So not only the listed companies, but also the private companies, the family businesses. It is also a very important directive because it is seen as one of the instruments to achieve the goals of the European Green Deal. Now, before going into detail into this new directive, let's first have a look to the current legislation and the current requirements. So the story about non-financial information has started in 2014, when the European Commission has issued the first directive with regard to the disclosure of non-financial information. That directive has been transposed into Belgian legislation in 2017, and as from that moment, certain companies were obliged to report non-financial information. I mentioned certain companies because the scoping is limited to public interest companies with more than 500 employees, and these public interest companies with more than 500 employees should also either exceed a turnover of 34 million or total assets of 17 million. So you see the scoping that we have today is limited to large listed companies. Now the question is, what is non-financial information and what type of information needs to be disclosed? The regulation refers to a number of topics. So we have the diversity topic, and then mainly diversity at the level of the board. Furthermore, we have the environmental matters, we have the social matters, we have the employee matters. And next to that, the company should also disclose its engagement with regard to human rights and anti-corruption. For every topic, the policy should be disclosed, the results of that policy, the related risks, and then also how management is managing these risks. And lastly, the KPIs, how the company is measuring the sustainability performance of the company, of course. Now, companies can report non-financial information based on any existing framework. And today there are a lot of frameworks. The most important ones are the GRIs and the SDGs, so the Global Reporting Initiative and the Sustainable Development Goals of the United Nations. But no, next to these two frameworks, there are a lot more frameworks that are currently being used. A last point that is important is that today there is no requirement to have an audit or to have a review on the non-financial information. What we can say is that we see a lot of companies that are having an external verification on a voluntary basis. And to give you some numbers, we have been looking to the 2019 reports of the BEL 20 companies, and there we noted that 11 of the 20 companies are having an external verification on a voluntary basis. Now, you feel and you hear that there are a number of concerns and there is a need for action. Some of these concerns are related to the scoping. The scoping today is too limited. It gives the impression that only the listed companies are accountable and are responsible for sustainability matters, which is of course not the case and it is not correct. Furthermore, the reported information is not sufficiently relevant and it does also not meet the requirements of the users. Another element or another concern is also related to the uncertainty about what to report. As I mentioned, there are a number of frameworks, different frameworks, which create the uncertainty for companies to know what they need to report exactly. Now, in the light of these concerns, the European Commission has launched a consultation in the course of 2020. So if you go to the next slide, yes. This consultation has been completed by users of non-financial information, by the preparers of non-financial information, so the companies, but also by the financial institutions who are both preparer and user of non-financial information. If we look to the left side of the slide, you see the key messages of this consultation. First of all, there was a strong support to expand the scoping. Secondly, with regard to standardization and with regard to reporting, from the point of view of the users, they were asking more comparability, more reliability, and more relevance. And from the point of view of the preparers of non-financial information, they wanted to have less complexity. They wanted to have one common standard to be used instead of a lot of standards that are now currently available. Another element, which is really a message from the users and from the investors, is the digitalization. They want that the reporting is being digitalized, that it is machine readable. And another important element as well is the requirement to disclose the materiality assessment. As mentioned earlier, there are a number of topics that need to be disclosed. Of course, companies only need to disclose the material topics, the most important elements. However, today there is no requirement to also disclose the assessment, how these material topics have been determined. Another element is the assurance. Based on the consultation, there was also a strong support for stricter audit requirements. Now, based or with these key messages in mind, the European Commission has drafted a new proposed directive for the reporting of non-financial information. So let's go to the next slide. On this slide, you see the key elements, or at least the key changes that we will see in the new proposed directive. First of all, the scoping. The scoping, here we have a significant change in the scoping. While today only the listed companies or the large listed companies are in scope, with the new directive, all large companies will become in scope. So not only listed, but again, as mentioned, also private equities, also family businesses. In terms of reporting requirement, I think there are three key elements. First one is consistency. Second one is integration. And third one is digitalization. With consistency, there will be one common standard being developed by the European Commission, and that standard will have to be used by all companies. Another element in terms of consistency is that the reporting will have to be included in a management report. While today you have the choice, either you include it in a separate report or in the management report, with the new directive, you will have no choice, no flexibility. It's one standard to be used, and it has to be included in the management report. In terms of integration, the taxonomy regulation will also be integrated in the new directive. And then in terms of digitalization, well, the reporting will need to be machine readable. A tagging system will have to be used in line with the tagging system that we will know, or that we already know for the financial statements today. In terms of assurance requirements, today there is no assurance requirement. With the new legislation, with the new directive, there will be a requirement to have an external verification on the non-financial information. And in that process as well, there will be some responsibilities for the audit committee. Now, the main aim of this directive is to give similar importance to non-financial information as the importance that you give to financial information. This is a directive, and member states will have the time to transpose this directive into member state legislation. They have the time to do that till the 1st of December 2022 to ensure that the legislation is applicable as from calendar year 23. What we are going to do now, we are going to give you more details about the scoping, about the reporting requirements, and about the assurance requirements. So again, the scoping, this is a very important element of the directive. The scoping has changed significantly. With the new directive, all large companies will be in scope. And you are considered as a large company if you exceed 2 of the 3 following criteria. First of all, we have the revenue, more than 40 million, total assets, more than 20 million, and more than 250 employees. So if you exceed 2 of these criteria, you are considered as a large entity. Maybe one side remark on this. In Belgium, we use different thresholds to define what a large company is. So in terms of revenue, this is 34 million. In terms of total assets, this is 17 million. So it might be when Belgium is going to transpose this directive that they will use the thresholds of 34 and the 17 million, but that we will need to follow up on the moment that the directive is being transposed into Belgian legislation. Also, the small and medium-sized companies, the listed small and medium-sized companies will be in scope. However, the application for the listed small and medium-sized entities will be as from 2026. They will get 3 years of benefit, and the Commission has explained this by the fact that these small listed companies will need more time to recover from the pandemic, and will also need to have more time to prepare for this, let's say, important milestone in terms of reporting of non-financial information. Another important element, non-European Commission companies, which are listed on the European market, these companies will also be in scope for this new proposed directive. Another element for which we received a lot of questions is what about daughter companies? What about subsidiaries? Well, there is an exemption for subsidiaries when the parent company is reporting non-financial information at the consolidated level, and the non-financial information of that subsidiary is included in that consolidated information. If the parent company is a European company, an EU company, then there is no issue, because that parent company will anyway need to use the regulation from Europe. If the parent company is a non-EU parent, then a check would be performed if the reporting of that non-EU parent is being done according to the requirements of the European Union, and a mechanism will be created to do a check if that reporting is also equivalent to the European reporting requirement. So this is a scoping, and maybe to give you some numbers, with the current legislation, we have more or less a scoping of 12,000 companies in Europe. With the new proposed legislation, there will be more or less 50,000 companies in scope. So you feel, or you see, that this change will have a significant impact on a lot of companies. I hand over now the word to Bart, who will give you more insights about the reporting requirements and also about the assurance requirements.
Thank you, Sophia. The key elements to be reported on are mentioned on this slide. In the next minutes, I will guide you through the main elements to be reported on. And I know it's a lot, even for companies that are already compliant today with the Non-Financial Information Directive. I will zoom in on 6 elements that are mentioned on the slide. The first element regards the business model and the strategy, and mainly how the business model and the strategy are resilient in a transition towards low carbon economy. Concretely, what are the plans of the company to transition towards a low carbon economy? What is the current status of these plans? Did we involve stakeholders to influence our strategy? What are the current opportunities that the company is seeing to transition towards low carbon economy? The second element to be reported on regards the targets, meaning, for example, how much carbon will I reduce in 2030? Will I achieve carbon neutrality in 2050? And how far am I today compared to the targets I've defined for 2030 and 2050? The next element regards the sustainability policies. And moreover, what is a company doing to enforce these policies? What are the processes a company is using to perform a due diligence, to take actions to prevent sustainability risks, or to remediate specific sustainability risks that were identified? A fourth element regards governance. So there will be a more emphasis on governance bodies and their role linked to sustainability. A fifth element, and it's mentioned on the right side of the slide, the first bullet, it regards also an additional reporting regarding intangibles, meaning what is next to the financial figures, what are the human capital, what is the social capital of a company, what is a company doing regarding research and development. And the main reason behind that is to understand better for investors the difference between book value and market value of a company. Last point mentioned on the right side, it's also a very important element. It's not only about reporting on a company's operations, its products, but it's about reporting on the entire value chain. So also including your suppliers, your clients as well. Next to the 6 elements I've zoomed in on this slide, I would also like to stress on the concept of double materiality. Double materiality was already there in the previous legislation or directive regarding non-financial reporting, but it was not really taken up by the different companies. And that's also the reason why it is now really explicitly embedded in the new legislation regarding corporate sustainability reporting disclosure. What does it now mean in practice? So it means what is the impact of sustainability on a company, meaning what is the outside in regarding sustainability, but as well, what is the influence of a company on the environmental side as well as on the social side, meaning what is the inside out of a company towards sustainability. If we go towards the next slide, there we have included additional elements that will change by the new CSRD legislation. And the first foundational and game-changing element for me is really the creation of the common EU sustainability reporting standards. These standards will be developed by the EFRAG, and the EFRAG is the European Financial Reporting Advisory Group from the European Commission. The standards will be developed considering already the existing reporting standards, such as the Global Reporting Initiative, the Sustainability Accounting Standards Board, IFRS, Carbon Disclosure Project, TCFD, and so on. But it will also, of course, consider the main ambition of the EU Green Deal to become carbon neutral by 2050, as well as the different pieces of legislation that are currently being submitted, like, for example, the EU Taxonomy, which is going to give a common definition of what is a green activity for a company, as well as the Sustainable Finance Disclosure Regulation, which is used by banks to disclose about the sustainability impact on investment products. The common reporting standards will then further guide on the different aspects of ESG, on what are the criteria to be reported on, what will be the indicators to be reported on, and so on. What are now concretely the timings regarding the release of this common EU sustainability reporting standard? So there will be a first wave of the standard coming by the end of 2022, and a second wave will be there at the end of 2023. Also, specific sector disclosures will be available by the end of 2023, as well as the specific standards which Sofian explained in the beginning for SMEs will also be available at the end of 2023. What is also the ambition of the European Commission is to review these standards every 3 years, just to consider also what are the latest developments regarding international standards, what are developments that are and other developments that are ongoing. Next to this EU sustainability reporting standard that will be established, we have also another fundamental change, like Sofian already mentioned in the beginning. It is the fact that sustainability information needs to be reported as part of the management report, meaning we go towards the evolution of an integrated report where financial and non-financial information will be considered together in the management report. Also, as already mentioned in the key, by Sofian as one of the key changes is the digitalization. So financial statements as well as the management report will need to be prepared in a machine-readable format. And specifically for sustainability information, specific tags will need to be added. Also, the information will be put available towards a common reporting platform that will be set up by the European Commission. Last point we would like to zoom in is on the next slide, is how are we going to move forward regarding the credibility of the sustainability information as well as the accuracy of the sustainability information. And there, the European Union has as objective to go towards a journey to come at the end towards a state where we want to have the similar level of assurance for financial reporting as for the sustainability reporting side. As I mentioned, it will be a journey. So we will start with limited assurance requirements, but these will progressively change towards reasonable assurance, meaning also the process around sustainability reporting will be tested. Also, the internal controls will be tested, as well as more substantive testing on the non-financial data will be performed. Now, what will be part of the work that will be done by the auditor? And there we identify 4 activities. First activity will be that we need to check the compliance of the sustainability report compared to the European sustainability reporting standards I've talked about on the previous slide. Second activity is also the auditor will need to understand the process that the company used to identify the sustainability information. So it will go in more detail on the materiality matrix a company is producing, also how the company has included its stakeholders to determine the non-financial information. A third activity that an auditor will review is the digitalization aspect. So really looking if the markups, the digital tags are properly included within the sustainability reporting. And the last aspect is then, and we will zoom on that part as well in the next session, is regarding the EU taxonomy. Over there, you will need to report a percentage of green turnover, percentage of green OPEX, as well as a percentage of green CAPEX. And it will also be the role of the auditor to review if that has been properly calculated. Also mentioned on the right side, the role of the audit committee will need to be clarified further. So it will be responsible to report about the outcome of the assurance on the sustainability work towards the supervisory body of the entity. But it will also need to be specified from what is the audit committee doing to guarantee the integrity of the sustainability reporting. We need to reflect further on what is the role of the audit committee in the process of compiling sustainability information. Will it be a challenger of this information? Will it rely on the sustainability committee for this information? That are all aspects that will need to be reviewed further as well. I will now hand over to Tom, because as I already mentioned, there are links as well with the EU taxonomy, and Tom will zoom in further on this EU taxonomy.
And thanks to my colleagues for clarifying the importance of sustainability reporting and the key evolutions which we can expect over the coming period. Now, over the next 10 minutes, I will provide an overview and update of the EU taxonomy. But before doing that, let me clarify the connections between three major regulatory initiatives. Now, the NFRD and proposed CSRD have already been tackled. They are all about transparency of sustainability towards all stakeholders of an organization. Now, one important category of stakeholders are the financial institutions who want to provide investment advice to their clients and develop sustainable products. It is here that the SFDR comes into play. So, in other words, the SFDR is mainly about providing transparency on sustainability on financial products, such as investment funds, pension funds, and insurance products. We also have to define, however, which economic activities can be considered as sustainable. Up until now, there has never been such a universal classification tool. Now, this is the main objective of the EU taxonomy. It is the first green classification system, although I have to mention that similar initiatives are ongoing in other geographies outside of the EU. So to summarize for this slide, the EU wants to make sure that all of these transparency and reporting requirements are aligned and consistent. Let's now dive a bit deeper into the origins of the EU taxonomy. In order to meet the EU's climate and energy targets for 2030 and reach the objectives of the European Green Deal, it is fundamental to direct investments towards sustainable projects and activities. The current COVID-19 pandemic has reinforced the need to redirect capital flows towards sustainable projects in order to make our economies, businesses, and societies more resilient against climate and environmental shocks and risks. To achieve this, a common language and a clear definition of what is sustainable is needed. This is why the Action Plan on Financing Sustainable Growth called for the creation of a common classification system or a EU taxonomy. So you should really consider the taxonomy as a tool or classification system which will be used as a basis for other requirements. The taxonomy in itself will, for example, not define in which companies you should invest or cannot invest. When we talk about the taxonomy, I also have to mention the regulation which is behind it. Now, this taxonomy regulation entered into force on the 12th of July 2020, and it establishes the framework for the EU taxonomy by setting out 4 conditions that an economic activity has to meet in order to qualify as environmentally sustainable. More on that topic on the next slide. So next to these 4 conditions, on which I will come back in a few moments, the taxonomy regulation establishes 6 environmental objectives, as you can see on the left-hand side. So the first one being climate change mitigation. So mitigation of greenhouse gas emissions over the entire life cycle. Second one is climate change adaptation. So being the reduction of the current or future negative impact of climate change on people, nature, and economic activities. The third one is sustainable use and protection of water and marine resources. The fourth one, transition to a circular economy. The fifth one, pollution prevention and control. And then the last one is protection and restoration of biodiversity and ecosystems. Let's now have a closer look at the 4 conditions as visualized in the funnel on the middle. So as a company, you will probably have different economic activities. That is the starting point to identify which of those activities are compliant with all conditions of the taxonomy. The first condition is substantial contribution. So substantial contribution is defined separately for each of the 6 objectives, but can either be a substantial contribution based on the economic activity's own performance or economic activities that enable a substantial contribution in other activities. So for the own performance, this could, for example, be a company active in providing renewable energy to its customers. For an economic activity that enables a substantial contribution in other activities, this could be the manufacturing of renewable energy technologies. The manufacturing process itself may not be sustainable, but these technologies will be used in sustainable activities of other companies. Next to substantial contribution, a second key concept is the do no significant harm principle. As the principle states, the objective is to make sure that the economic activity does not harm any of the other objectives. So it's clearly not sufficient to just contribute to one of the 6 objectives. You may also not significantly harm any of the other objectives. Now, a topic that has not received much attention in the current debate over the taxonomy regulation is the role played by the minimum safeguards that target human rights. Contributing to this lack of human rights-related discussion is a common assumption that the EU taxonomy is all about climate change. However, an economic activity will only qualify as environmentally sustainable if it meets minimum safeguards in the area of international human rights. As a 4th step, the taxonomy regulation tasks the Commission with establishing the actual list of environmentally sustainable activities by defining the so-called technical screening criteria for each environmental objective, and this is done through delegated acts. Now, a first delegated act on sustainable activities for climate change adaptation and mitigation objectives was published very recently, so on the 21st of April 2021. Now, a second delegated act for the 4 remaining objectives will be published in 2022. Now, in 2021, the Commission will also adopt another delegated act specifying the information companies subject to the Non-Financial Reporting Directive, NFRD, or the future Corporate Sustainability Reporting Directive will have to disclose on how and to what extent their activities are aligned with those considered environmentally sustainable in the EU taxonomy. This will be reflected in percentages of turnover, CapEx, and OpEx. So, for all economic activities that comply with the 4 conditions, companies in scope of the CSRD will have to disclose these metrics. I will now provide some more details on the next slide. So again, what has to be disclosed? First of all, the proportion of turnover aligned with the taxonomy, and as well the capital expenditure, and if relevant, the operating expenditure aligned with the taxonomy. So mandatory disclosures for companies in scope of the regulation, but at the same time also an opportunity to provide transparency on your sustainable activities. For example, companies will be able to disclose the extent to which they invest, for example, through capital expenditures, in either expanding or strengthening their activities which are already taxonomy aligned, or to upgrade other activities to make them taxonomy aligned. Disclosure on green revenue and green expenditure will provide the market with information on companies whose activities comply with the EU taxonomy criteria through disclosure of revenue share from taxonomy-aligned activities, and companies that are taking steps to get there through disclosure of green expenditure. The new reporting requirements associated with the EU taxonomy are likely to significantly increase the informative value of non-financial reporting by establishing a link between financial and non-financial matters for the first time. Now, there are some mandatory disclosure rules defined in the taxonomy regulation, but alongside these, companies can also use the EU taxonomy voluntarily. These corporates can follow the so-called 5-step due diligence, which is again a reflection of the 4 conditions detailed on the previous slide. So as a short recap before we jump to the example on the right-hand side. The Corporate Sustainability Reporting Directive, or CSRD, will ensure alignment with other EU initiatives on sustainable finance. In particular, the Sustainable Finance Disclosure Regulation, or SFDR, and the Taxonomy Regulation. The aim is to reduce complexity and the potential for duplicative reporting requirements. This proposed CSRD will ensure that companies report the information that investors and other financial market participants subject to the SFDR need. Article 8 of the Taxonomy Regulation requires companies falling within the scope of the existing NFRD and the additional companies brought under the scope of the proposed CSRD to report on the extent to which their activities are sustainable. The indicators for this will be specified in a separate Commission Delegated Act. Companies will have to report these indicators alongside other sustainability information mandated by the proposed CSRD. The reporting standards to be developed under the CSRD would fully take into account these indicators and build on the substantial contribution and do no significant harm criteria of the taxonomy. On the right-hand side, we have visualized this in an example where we start at the bottom on the asset level. So suppose that we have a company with 3 different economic activities. So economic activities A, B, and C, and together, of course, they reflect 100% of the turnover of the company. Now, activity A is already from the start fully aligned with the conditions of the EU taxonomy. So no changes, let's say, need to be made there. However, for activities B and C, as you can see, some of the criteria are not met yet. So in case of B, it does not meet the emissions thresholds, and in case of C, the do no significant harm criteria are not met. Now, what the company can then do is launch a project to make sure, so let's say to do investments to make sure that also activities B and C are in line with all the criteria of the taxonomy. In case the company does this, it can claim that all the capital expenditure which went into this project is also aligned with the taxonomy, and you can report it as such. The company could even issue a green bond to use, let's say, the funding of that green bond for this project. Now, as a result of the project, the 3 economic activities of the company are aligned with the taxonomy. So then the company can also claim that 100% of the turnover is aligned with the taxonomy. This is, of course, a very much simplified example, but it shows you more or less how the principles are working. Now, on the next slide, as a real life example, so Deloitte supported EnBW, so which is a publicly traded electric utilities company headquartered in Germany, with the taxonomy requirements. So for this case study, the perspective of a company operating in the real economy was chosen for the purpose of presenting and interpreting the requirements relating to the implementation of the EU taxonomy. Now, as a result of this case study, a 35-page report was prepared and published, which is aimed at all stakeholders in the sustainable finance community. So being standard setters, investors, policymakers, civil society, and of course also other corporates. The case study demonstrates under which conditions the implementation of the EU taxonomy regulation is both sensible and possible, but also demonstrates that implementation requires sufficient lead time and the involvement of various experts beyond the sustainability department. In summary, I can really recommend reading it to all of you if you want further practical insights into the taxonomy. Now, we hope that this session has been very insightful to all of you, but before we formally close, I will hand over to Tom for the ending notes.
Thank you, Tom. The only thing that rests me is to thank, first of all, Ariane, Laure, Tom, Bart and Sofian for preparing this on a very short time frame, given that we had the publication on the 21st of April. So thank you for that. But I would also like to leave with a couple of reflection points for the audience. I believe we have quite some finance people here on the call, and I have 2 points for them. First of all, as finance people, we own and typically master financial data and performers. And the question is, will you as a finance professional in the future only report on non-financial data, or will you also own and master them like you do with financial data? A second reflection point I would like to bring to the finance professionals here on the call is we always use financial data to challenge the business. Will you also use actually this non-financial data to challenge the business? So it's really about what is the role of finance going to be in this transition? And that's, I think, something you should reflect on. Also, for the sustainability professionals on the call, it might be worthwhile thinking on how you kind of collaborate in this whole program between the finance organization and the sustainability organization. I hope with this, we were able to bring you some first thoughts on where to start. Our recommendation would be, do not start too late. Try to start also with the end in mind. And in case, of course, you would have doubts or questions, you know whom to reach out to. Before I will close this seminar, we would really appreciate if you would be able to fill in the poll so we can learn from this experience and if we should change or improve something for upcoming webinars. And with this, I can only wish you a good lunch, take care, and enjoy the weekend.